All right, good morning. Let me get this guy out of the way here real quick. Come here. There we go. Okay, so good morning. Thank you for joining us. This is going to be a two-part session talking about the ACA and what we call the practical stuff, actually having to deal with it. This first part of this webinar is going to go over the actual rules and requirements of the ACA because it's important for you to understand what's actually involved in handling the ACA. Many of you are probably already aware of what we call the general provisions, or making sure your health insurance plan is affordable and making sure certain people get enrolled when they're supposed to if you have hourly staff. So what we're going to do in this phase, though, is kind of dive in deeper because most brokers that we find out are saying, hey, talk to the payroll guy, talk to your accountant, or whatever the case is. And most of the brokers are not really preparing their clients for the ACA and actually dealing with it in subjects ranging from making sure eligibility is properly tracked all the way down to ERISA. And we're going to tackle those things. The second part of the webinar is going to talk about solutions. These are going to be pre-recorded, so that way you can go ahead and watch them at home if you're sitting in your pajamas by the fire, if you want to do that, or if you're just drinking a beer at night and you want to listen to some ACA talk. If you have any questions with this, please feel free to reach out to us. You can reach out to us via email or or on the phone. You can also find out more information on our website. We are going to be producing a lot more of this stuff quite rapidly to get up with our July 1 launch date of PRS benefits. So let's go ahead and dive in. So just a little bit about PRS. Many of you that are listening to this are already clients of PRS, but you may not be aware of some of the other things that we have done since you being just a payroll client. PRS, our motto is more than just payroll. We have been doing full benefits administration since 2010, and we offer everything from health insurance, dental, life, disability, special cancer riders, things like that, the whole gambit. So we don't just do payroll, and this isn't new to us. We've been administrating both small groups and large groups for quite some time. A small group is what we call under 50 employees, and then large group is over 50 employees. So this isn't new to us. We've been advising clients for some time, and we're able to shop every carrier in the tri-state area, range from CareFirst, United Health, Aetna, whatever the case may be. We offer complete COBRA, HRA, and FSA administration. And one of the things which is really neat about what we've done is we really actually have been on the forefront of the ACA since its inception. We have taught classes to Maryland Society of CPAs and accountants. We've been talking to people about the ACA for a long time. And the one thing that I really enjoy about being in this position, and any salesperson should appreciate this as well, is we get to speak to hundreds of company leaders each year. So we know what is going on out there in the industry, not just in payroll or benefits. We're talking to people in IT, security, biological things, the whole 9 yards. We get a grasp of a lot of different things of what company leaders are. I joke around with people and say a salesperson is the most influential person you'll ever meet because we get to meet with the most CEOs, CFOs, CTOs than any other people out there. And that's really helped us get an idea of where the market is and where the industry is shaped right now in regards to the ACA and some of the problems that most businesses are encountering with this. The first thing that we're going to discuss, and if you're watching this, you probably fall into this, is what we call ALE. Okay, what is an ALE? It's not a beer. It's not an owl. An ALE is what we call an applicable large employer. It simply means that you have over the 50 full-time equivalent threshold, and now you are subject to all the Obamacare or ACA mandates. So we're going to talk about what a full-time equivalent is in a little bit. Very simply put, a full-time equivalent equals any combination of employees that equal 1,560 hours a year. That equals one full-time. So for example, if you are a client that has lots of part-timers, And let's say we take 6 of your part-timers and add up all their hours, and it equals 1,600 hours. Well, that's one full-time equivalent. Vice versa, one true full-time person equals a full-time equivalent. So a full-time equivalent simply equates to the amount of hours worked by your workforce. The way that we deciphered it is about 130 hours worked per month or 30 hours worked per week. There are some caveats for seasonal employers, and we're not going to get into that. It's very specific. You do see the excerpt down there at the bottom. So very simply put, an ALE is anybody that has over 50 full-time equivalents. You could have 100 part-timers that work 15 hours each a week. Well, that's 100. That would be 50 full-time equivalents. So that's what an ALE is. Very simple. The next thing what happens is when we talk about ALEs is what we call controlled groups. And I'm going to try to keep this very simple. And essentially a controlled group is any type of entity that owns multiple companies. And that entity could be an individual. That entity could be a company, such as a management company. It could be a lot of different things. But ALE controlled groups are really broken down into two main areas. The one is what we call parent subsidy, which is we're going to look at the most because that's the most common thing with most business owners. The second one is what we call a brother-sister group. A brother-sister group is essentially think of it as a management company. And then we have a combined group, which is a combination of both a brother-sister group versus a parent subsidy group. So let's take a look at some of these and how this works. A parent subsidy group, okay, very easy. It is a management company, has a bunch of sub-companies underneath of it, and that management company is the primary owner of those, okay? Very simple with that. The brother-sister group is where most clients that we deal with fall into. It's business owners that have different companies. And it's really simple on how we figure this out. So if you look at this example here, on the left we have an ABC Co. and on the right we have XYZ Inc. And then we have a list of shareholders there. And essentially what we're doing is we're listing out the shareholders' percentage of ownership in each company. And the rule is whatever identical ownership would be, and if that equates to 80% or more, it's considered a brother-sister group. And then it would be added into, your employees would be added to the ALE calculation. So we can see in this one, shareholder A owes 33% of ABC Company and 50% of XYZ Inc. So when we go ahead and take a look at identical ownership, the identical ownership is 33%. And the way that we figure that out is we take the lowest ownership that he has out of the companies, and that is considered the portion that we use to figure this out. So you can see that between shareholders A, B, and C, that we equate to 83%. And that would make this a part of the ALE calculations. The next thing that we need to talk about is the penalties. It's really important to understand this so that way you can plan it. Taking the penalty may be an option for your company. These are certain things that we discuss when we sit down and strategize with other companies, whether or not they need to offer benefits. Is it better to send them all to the exchange and see what happens, or whatever the case is? So there's essentially two methods of figuring out this. The one is if you don't offer insurance. And the way that the penalty works is if an employee goes to the, well, in this case it would be the state exchange pending what the Supreme Court says. Well, let's assume it's Maryland. If an employee goes to the state exchange and that employee receives a subsidy, now the employer is faced with a penalty. Okay? Right now, the penalty is based off of the total amount of employees minus the first 30 times $2,000 would equate to your penalty. Okay, so the way that the penalty would kick in is as soon as one employee gets that subsidy, then the penalty would kick in. If none of the employees got a subsidy, there would be no penalty. The premise is based off of that you're supposed to offer affordable insurance, and if you don't offer it, the employee goes to the marketplace, the government subsidizes it, so they go back and ding you for that difference. So again, very simple, no insurance, If you have any employees that go to the marketplace and get a subsidy, it's $2,000 per full-time employee minus the first 30. Notice it says full-time employees, not full-time equivalents. Okay, that's important to recognize here. Full-time employees are the ones that are eligible for insurance. The FTE simply dictates whether or not you are subject to the ACA mandates. So the penalty is based off of full-time employees. The second penalty is based off of if you offer unaffordable coverage or inadequate. We're not going to focus on inadequate because if you offer coverage, pretty much any coverage you get through CareFirst, Aetna, United Healthcare, all those guys, it's all going to be adequate. So we don't have to worry about that. But what we do have to worry about is if you offer unaffordable coverage, and we're going to talk about what that means in a moment. However, the way that this penalty works is that it's the lesser of either $3,000 per subsidized employee or the $2,000 per full-time employee minus the first 30 as in the calculation above. And so with the example, just so you can see, because it may make better sense with the numbers, is if 2 full-time employees get a subsidy, that penalty would be 2 employees times $3,000 equals $6,000 in penalties. But if 14 of your employees got the subsidy, 14 times 3 would be $42,000. So the lesser of the penalty would actually be the 50 employees minus the 30 times 2, which would equal $40,000 there. So that's how the penalties are broken up into one or the other. And this is what we essentially call the pay or play strategies. We need to figure out what the impact is to the company, because making something affordable to the employee might cost your company more than $2,000 a year. All right, so in 2015, we have a couple of exemptions going on here, and it's very simple, all right? Everybody's probably, well, you may not know about it, but there's what's called a 1095-C reporting, which is what we're gearing up to be able to do for you. Everybody must file those. However, the exemptions apply to the employer shared responsibility, and that's what the penalties are based off of. So employer shared responsibility is essentially how much you need to kick in order to make something affordable. If you have less than 100 full-time employees, including full-time equivalents, which is what it's targeting, you're not going to be subject to the employer share responsibility, and that's based off of 2014 numbers. Anything going forward, you would be required to meet those requirements, or you would face the penalty. If you were over 100 full-time employees, then essentially instead of reducing the penalty by the 30, it'll be reduced by 80. So if we go back and rewind to that previous example, the example was 50 minus 30 equals 20 employees times my penalty. Well, if I'm over 100, we would reduce it by 80 instead of the 30. So those are the two big exemptions essentially for the employer shared responsibility. So now we need to talk about what this term of affordability is, okay? Affordability is not just a word definition. It's actually a mathematical definition, which is based off of 9.5% of the employee's earnings. There's several ways of calculating this, but that's what affordability is, 9.5%. So let's take a look at how affordability works. You don't know what your employees make. You don't know if if it's only their only job and there's no other source of income. Obviously, you have that data in front of you. But many employees are dual income families, or they may have investments on the side. So in reality, employers don't know what employees are making. So that was one of the struggles with when we come up with, well, what is affordable? Affordable is defined mathematically by each employee. So what's affordable to you may not be affordable to me. If I'm making $1 million, well, my threshold for health insurance is 9.5% of my income. It's much, much higher than if somebody's making $50,000. So the way that the IRS came out and said, okay, this is what you're allowed to do in order to ensure that you are in the affordability area, is they provided 3 thresholds. The first one is the Form W-2, which is wages. We call this safe harbors. So essentially with the Form W-2, you're basically going to go back at the end of the year when you get the W-2 and say, okay, my W-2 box 1 wages was X times 9.5%, and that's what my premiums for individual coverage only better be under. Now the problem with that is, when do we get the W-2s? Well, December 31st. Well, the problem is the penalty is assessed monthly. It's not at the end of the year, so it's not like I can just dump a bunch of money into the employee. If it's unaffordable for any portion of a month that the employee has coverage, I'm getting penalized. So that's not going to help me out at all. We're going to skip number 2 and talk about the federal poverty line safe harbor. The federal poverty line safe harbor is a good method to use. However, it can change. If somebody has a new dependent, well, now the FPL is going to change. If somebody loses a dependent, maybe they're not claiming their kid anymore because he's out of college and moved out, well, it changes the FPL. So that's a moving target, which can be done, but is not as efficient as the best way, which is the rate of pay safe harbor. So the rate of pay safe harbor, which is what we focus on when determining affordability, is we take the rate of pay that that employee makes at the time of eligibility. We can estimate that out based off of full-time hours or based off of his salary rate, and then we multiply that by 9.5% to come up with his affordability. That is the safest way of dealing with this. Again, there are 3 safe harbors. We have adopted the second one. And what's important to understand with all of this, guys, is that this has to be documented. And this is where it comes back to with the brokers when they're not educating their clients enough with these. I'm very outspoken with this. The brokers are involved in health insurance. They should have been the ones here coaching you, not just saying, hey, this is what you need to do to make sure your plan's okay. They need to actually set all of this up. They needed to be talking to you about all these different things. And this is where we're finding a lot of lack of education inside the business community. Again, we talk with hundreds of CFOs, CEOs, and treasurers, you name it, and all of them are sitting here going, how do we figure all of this out? There's a lot of compliance. Again, the rate of pay for the safe harbor is based on the employee's rate of pay once coverage begins or eligibility. Adjustments are permitted only if the pay is decreased, okay? So basically, if you reduce the employee's pay, you can go ahead and adjust what's affordability, give him more money or whatever the case may be. But you can't change the affordability if you increase his pay. Remember, back to my example, if I'm making $1 million, 9.5% is much higher than if I'm making $50,000. So that's what they're talking about here. Essentially, what you need to know is once an employee becomes eligible for insurance, his rate is locked in. Excuse me, his affordability is locked in until the next open enrollment period when he would be eligible. So again, affordability is throwing a dart at a dartboard in the dark and hoping you hit it unless you have the tools to implement it. Now, is it affordable? What do we do? If it's not, how do we adjust this? Well, the first thing could be increase wages, right? If we increase his wages, we increase what's affordable. It's a very valid tactic to use and a valid strategy to implement. But again, we need to have a session where we sit down and we actually implement these strategies. And we need a way to track this. It's all fine and good when the broker comes out and talks to you about all this during the renewal last year or whatever. But what about ongoing employees? What about your new hires? How are you ensuring that all this is taken care of? The second option is can we increase the contributions for that employees? This is a very hot topic in the HR area with those that are involved in ACA, and I'll explain why here in a second. Let's say we have 3 different employees. They're all admins, okay? One makes $14 an hour, one makes $18 an hour, and one makes $10 an hour, okay? They're all full-time. Their affordability is all different, right? It's different if it's 18 from 14 to 10. 9.5% is different. So what if but remember, they're all administrators. What if I increase the contribution for the $10 an hour person? Is that okay? they're doing the same things, right? We haven't defined eligibility classes in our benefits. You know, it's not like an executive versus a salesperson or something, right? Did you discriminate? These are things that have to be worked out. So what we're starting to see here is not only the benefits portion with health insurance, it's also we have to blend in the HR, and now we're starting to blend in payroll. We're starting to blend in all these different aspects to handle this. This isn't just hey, here's a real easy, you know, form, fill it out, and you'll know everything that you need to do. These are ongoing things that you need to decide in your organization. Contributions can be different from employee to employee as long as you have it defined in your benefits plan and as long as you're not discriminating. You have to set up eligible classes for these, okay? We can have a management staff. I can have an admin class. I can have different contributions, but the problem is inside that class that I've defined, I can't have different contributions. The contributions must be defined, otherwise you do risk discrimination. And that's one thing that a lot of people aren't talking about, and if you see some calculations, they'll just say increase contributions. Well, you have to increase them for everybody. The other option is do you take the penalty, right? I don't know. If you have one person that would be better off going to the exchange and it would cost you $3,000, you know, is $250 a year? Is it going to cost you more to give them $250 plus to get that affordability down? These are some things that you need to decide and how we need to strategize. So the next thing, which is an ongoing struggle, and this is really where ACA starts getting more burdensome, okay, is we need to start tracking employee classification. Employee classification is simply broken up into three categories. Two, which is really what you will use when you hire an employee. Eligible, which essentially means they're eligible for insurance, okay? You hire somebody that's full-time, you know they're going to be salaried, they're manager or whatever, they're full-time, okay? Very easy. Ineligible, which is simply defined as they don't make it. They're not full-time. They haven't been defined as eligible inside the ACA realm of benefits. Variable. Okay, variable are simply your hourly employees. Whenever you hire an hourly employee, they automatically become variable. Okay, so it's very simple. When you hire an employee, they're either going to be eligible or they're going to be variable. And it's important to understand these two concepts because they will build when we start talking about what we call the measurement periods later on. So again, whenever you hire a new employee that is not defined as full-time, they will be variable. So employee tracking, how do we track all of this, right? You know, you got to figure out if this variable employee is going to be eligible or not. Well, it's very simple. It's through timekeeping, okay? If you are over the 50 mark, you must have a timekeeping system implemented. And here's where the struggle is going to be for some organizations. Our timekeeping system is very robust, okay? We can do a lot of different things that most companies can't because of the way that our back end is programming through scripts and things like that. However, if you are in the contractor field and you do a lot of job costing for billing, you may have a system implemented where you are starting to track the hours worked on jobs for billing. Okay, so if you're an air conditioning company, if you're an electrician, things like that, you may not necessarily be tracking the actual time worked, you're tracking billable times, right? That's how you've probably been doing it for years because you need it to make money. You need to bill your client. How do I know that? Well, what happens now when you have employees that are variable, which oftentimes contractors are, but you're not tracking the correct amount of time? Well, now you're going to risk big penalties because you don't have that. So it is crucial that you have to implement an employee tracking system, which is based off of timekeeping. And it must be electronic now, guys. If you're watching this video and you're still using paper punch systems where, you know, the old, you put that vanilla card in and it punches, it's time to upgrade. Call us. We'll get you set up something. It's very inexpensive to get going, but you need to have something electronic. And the reason why it's got to be electronic now is we got to be able to run all of these calculations and getting all these statistics so we know what's going on in the organization. All right, so this leads us to the next one, and this is probably the most complicated portion of the ACA. And this is where most brokers have failed to truly help their clients with this. We have 3 periods, which is called the measurement period, the administration period, and the stability period. Okay? Simply put, a measurement period defines whether or not an employee is considered ineligible or eligible. It also defines whether or not you are in ALE, okay? Because we are looking at a 12-month consecutive period of time, and we're computing all the data for it right then. The measurement period is one of the most confusing things, so we're going to spend quite a bit of time here to make sure you understand it. And you might have to rewind and re-listen to some of this because, again, the measurement period is quite confusing. The administration period is very simple. It's the time that when you find out an employee is eligible, that you have to get them enrolled. I can't stress this enough. It cannot be any longer than 90 days. One of the things that we do with every single group that we broker health insurance for is we make sure that this administration period is documented properly in the plan docs. Okay, what happens is most people would say, okay, it's going to be 90 days following the first of the month, on the first day of the month following their new hire. So, for example, if you hired somebody in June 15th, their 90 days would be September 15th, but they wouldn't be eligible until October 1. Well, based off of the new ACA rules, that would be a penalty zone for you. You would get penalized for not offering insurance. It cannot be any longer than 90 days. So what we do is at a maximum, it's 60 days following their. It's the first of the month following 60 days after hiring. That way, you are never ever outside of the administration period. So that's one of the things that we do. We go through and we scrub these. But again, these are things that need to be defined. The stability period is the simplest one. It's simply your benefit plan. It's a 12-month period of time, and it's going to correlate to that medical plan or whatever the case may be there. So let's talk a little bit about the measurement period. Most companies are behind on this. Again, we talk to hundreds of company leaders a year, and the more and more we talk to them about this, the more and more they're scratching their head and they're going, holy cow, how the heck are we supposed to deal with this? Initial measurement periods were supposed to start in 2014 because you had to have one in 2015. Okay, according to ACA rules, you were required to have a stability period in 2015. So the question is if you had a stability period in 2015, right, and you were supposed to do this measurement period, where are you in that measurement period today? You should be in a phase of it right now. Okay. Measurement periods need to be designated to correlate with benefits. For example, if we're going to have a 3-month administration period, then my measurement period, and my medical plan is going to start in January. I want to back up from January 3 months, and that's when my measurement period needs to end. Because again, once the measurement period is over, you know if an employee is eligible or not. You then enter a 3-month window of getting him enrolled. So we want to stack it so it matches up right to your benefit plan. And in this example, you'll see that if you had a stability period of January in 2015, that your stability period runs from October 2013 to October 2014. And if you see that, that's in year 1. And then you see the 3-month period of time for your admin window, which butts up right against your plan start date, which is January 1. Okay? Then on year 2, if we take a look at it, your measurement period would again start October 2014, and it would run through October 2015. That's why I ask you, where are you in your measurement period? You should know this right now. You should know. If you're watching this, that means you're probably the one that was responsible for taking care of ACA and health insurance. And probably, based off of what we've talked to, most people don't know. And it's okay. That's why we're trying to help you get there. So again, a measurement period, and the initial one is simply defined as the period of time where we're measuring eligibility of employees and whether or not we are considered an ALE. The latest time that you should have had your measurement period was October 2013 to October 2014. And again, this is something that when we go in and we take new groups over, we take a look at when their plan renewal is, and we start trying to figure out how to back into these dates to make sure that you are in compliance going forward. So the initial measurement period is fairly simple to understand, but where it becomes complicated is that whenever you hire a new employee that's not eligible, they have their own initial measurement period, okay? Why? Well, they didn't fall into it. If your initial measurement period was October 2013 and you hired somebody in February 2014, they need 12 months of time to measure this, and they're outside of that. So every time you hire a new employee, it's like a moving scale. That employee is going to have his measurement period, which will define whether or not he's full-time or not. So in this example, you can see in April 1st, 2014, I hired a new employee, okay? That new employee's measurement period stems through April 1st, 2015, right? In that period of time, I say, okay, are you eligible or not based off of your hours? If it's yes, he then enters the administration period. And if you notice, he becomes eligible, or excuse me, his stability period starts in May 1st. And so that means at a minimum, he will have coverage from May 1 to May 1, even though our company measurement period was actually October 14. So that's probably another pretty simple concept. Each employee's one measurement period on their own. Where it gets confusing, though, is how does it happen after on year 2? On year 1, it's very simple. Employee has their own measurement period. But in year 2, that employee then converts into the company's measurement period. So if we look at the year 2 diagram there, we can see that the company's measurement period is October to October. So what's going to happen for this employee is that the employee's eligibility for the following year will be defined based off of the October 2014 to October 2015 window of time. The employee still cannot be kicked off of insurance until May 1, 2016, but the year 2 measurement period will dictate whether or not he can stay on or not. And that's the way that the eligibility periods, the measurement periods kind of leapfrog. So if you are in an industry that hires a bunch of full-time people, hourly people, such as manufacturing, if you're in the entertainment, restaurant business, all those different heavily hourly employees, if you're doing any type of home health care, this is going to be a big struggle for you guys. You have to track this, because if you don't offer that employee insurance when they're supposed to, or make them notified that they're ineligible, that's when you start getting fined. And remember, that penalty is it's not at the end of the year they assess it. It's a monthly penalty. So if you were out of compliance for 3 out of 12 months of the year, well, you're going to get 3 divided by 12, whatever that is, of the penalty. So that's what the measurement period is. Again, with this one here, this is something that a lot of the brokers have been steering clear of. They haven't implemented any systems for this. Some companies may be trying to run a reoccurring report based off of their own company's measurement period, but the fallacy is that's wrong. The employee has their own measurement period. So you really can't do this yourself. This is not a, hey, I'm going to make some homegrown system in my office and make it work. I suppose you could try, but you're talking tens of thousands of dollars of manpower to do this. Administration period, again, not going to take much time. It's no more than 90 days, and it's simply the time you have to enroll an eligible employee. Stability period, we just talked about that. That's the time that the employee is on the plan, and again, it should correlate for your benefit plan. Okay, so now what we need to do is we need to talk about it. All right, we have an eligible employee. Now what do we do, right? Well, we need to have the client, well, you need to be notified, obviously, of it. Okay, so whatever system you have in place, we need to notify, hey, got to get this guy on insurance right away, right? The employee needs to be notified. What if he's ineligible? What if he's eligible? All these things have to be done, and they have to be done in a timely fashion too. So this isn't like, oops, something slipped through the cracks. People are getting dinged for these things, and because the law is so gray, you have a lot of these different agencies like Department of Labor and ERISA going after companies just for these little penalties because they can collect money. Then the broker needs to be notified, okay? The broker needs to make sure eligibility is up there. So let's do a quick recap of what has to happen just to get you up to date with ACA stuff, right? We need to first and foremost make sure that you've done an FTE calculation, full-time equivalents, all right? You should have an idea. You may not know exactly where you are, but I'm sure most businesses know whether or not they're in that range or not. You need ongoing affordability calculations, okay? And remember, each affordability is for each individual employee, and that changes each year, okay? So we need to make sure of that. The other thing that you got to remember, guys, with this is not only does maybe your wages change each year, but your health insurance doesn't get any cheaper for the most part, right? Average increase is about 10 to 18%, depending on what plans you're on and what size group you are. You know, with the old method, we saw groups that jumped age bands as high as 28%, and that was for the same plan just because people are getting older. The next thing is we need to have set up and documented the appropriate measurement, administration, and stability periods. These have to be defined and documented. Okay, it's not going to work if you get an audit and say, "Oh yeah, sure, this is what it is." Okay, you have to have this defined, and we need to make sure that we have all the proper tracking put in place to implement these different periods. We then need to make sure we classify all of our new hire measurement periods, all right? And this is important for this year, guys. This year, you should have had your first stability period. So that meant you should have had a measurement period. You should have had an administration period. And you should have had any single new employee that you've been hiring outside of it should have their own measurement periods. So if you were running a 12-month report for your plan year, or what you thought was your company measurement period, you're risking yourself for penalties. That is incorrect, and you are now setting yourself up for monthly periods going forward. We have lots of clients that are in the 400 or 500 employee range. Remember, you do have some exemptions, but it's for the first 80, okay? You still can get penalized for this, and you have gaping holes. And trust me, I understand people are probably shaking their head going, holy crap, what's this going to cost? Extra compliance, extra work? We're already paying enough for health insurance. All right, we need to ensure appropriate enrollment, and we need to ensure the appropriate documentation. And we're going to talk about ERISA here soon. These are problems that are not being addressed by the health insurance brokers. They're saying, hey, talk to payroll, talk to accountants, talk to, the supermarket guy. It's okay, Mr. Broker, you've been getting paid all these commissions for so long. Don't you think you should know what's going on in your industry? We need to track your variable employees, and then we need to make sure that we have a timekeeping solution that's implemented in order to track employee eligibility. Again, all of this is just compounding and compounding. We have payroll, time and labor management, we have HR, we have compliance for Department of Labor and ERISA, and then we have health insurance at the end. So now let's talk about this 1095-C form. Some of you guys may have heard about this form, some of you may not have. This is kind of like the grand finale of the ACA. It's the W-2 at the end of the year. You've been offering insurance this whole time, you've been having to track all this. Well, the IRS says, good, great, let's see what you got. That's what the 1095-C is all about. The 1095-C is going to document various pieces of information in order to send a copy to the employee for them when they file their own personal tax return, and then also to file for, to file with the IRS as well. The problem with this form, right, is it has so many pieces of data that's required. Okay, you need dependents. You need their name and social security numbers and date of birth if you're offering self-insured plans. A lot of you guys are probably offering fully insured plans right now through CareFirst, Aetna, United Healthcare, whatever the case may be. But the other thing that has to be tracked, which I'm sure nobody has actually thought about, is when you let an employee go, they're eligible for COBRA, right? Yeah. Well, you got to track your COBRA participants. So are you tracking them in your system for these 1095s? There's all sorts of information that has to be put on this form. And the problem is all this data is coming from many different areas, okay? HR, payroll, health insurance, the whole 9 yards. There's a lot of different things going around. And that's why health insurance brokers are saying, hey, we're not doing this, because they don't want to do it. So we're going to stop at this point here. And then we're going to go ahead on the next session. We're going to talk about solutions and ERISA to make sure that you're actually in compliance of what needs to happen going forward. If you have any questions, go back and you can rewatch certain parts. You can also talk to us, give us a buzz, call us, go to our website. There's lots of information coming out about this. And in the next week or so, guys, we're going to be reaching out to every single one of our clients that are ACA mandated and discuss with them what solution needs to be implemented. You will have to have a decision by July 31st. No later than July 31st, that's when we will have to implement it. So you guys do need to start thinking about this and how you're going to handle these things. So stay tuned and come on back and watch the second part.